Good afternoon, everyone. My name is CA Aishwarya Joshi. On behalf of the Women Members Excellence Committee of ICAI, it is my pleasure to welcome you all to Yashaswini and Idol Series 39. Yashaswini and Idol is a Wednesday series of programs conducted by the WMEC for the women CAs and by the women CAs. This series is an extension of Sky High Symposium, which concluded its 100 episodes. It is one of the committee's initiatives to not only disseminate information to women members on technical updation and non technical skills, but also to empower and inspire women members to come at forefront and realize their verbal skills at a public forum. Without further ado, let me introduce our first session speaker, C.A. Sayali Thakur ma'am. Ma'am is a seasoned professional with over 15 years of experience, having worked with reputed companies like ICICI Prudential AMC, Godrej and Boys JB, and Tetra Pak India. She progressed from a management trainee to business controller for the South Asia market. Currently, she practices in business advisory and GST. Sayali ma'am, over to you.
Thank you so much, Aishwarya. Uh, good afternoon, friends. And this gives me immense pleasure and honor to be part of this series today. Just a moment, I'll just start my. I hope you're able to see my screen. Okay. So, yeah. So today I'm going to share you uh, information and knowledge which I gained during my experience on internal financial controls. Internal financial controls as per the Indian Companies Act 2013. Basically, it's about the way of doing business in a way which the business is in a controlled manner. So let's get started, and first we'll look into the introduction to the IFC. So we'll start with the definition of IFC. The Companies Act 2013 defines internal financial control as policies and procedures that the company uses to ensure that its business is conducted in an orderly and efficient manner. IFC also include measures to safeguard the company's assets, prevent and detect errors and frauds, and ensure the accuracy and completeness of accounting records. So the Companies Act is trying to say here, it is trying to bridge the bridge between the governance of a company and the best standard of practices. So here, Companies Act is asking the companies to have certain policies and procedures to conduct the business in an efficient manner. It includes to have certain standard policies to safeguard the assets, to detect errors and frauds, and to ensure to have accuracy in the day-to-day transactions. The objective as defined ensures the accuracy, reliability, and transparency in the financial reporting. In the current business scenarios, as we are going ahead in the World Forum, this is a very important thing in the world market today because the world investors are coming to our country. So they are expecting certain internal controls in any organizations where they are interested to invest. So how is the relevance of IFC? So this requirement is coming in Companies Act through the section 134(5)(e). What does this section say? So according to section 134 subsection 5(e) of the Companies Act 2013, the director's responsibility statement must state that the directors have established internal financial controls and that they are adequate and operating effectively. So here through this section, we understand that the law or the act is putting the onus or ownership on the directors of the company to have a firm internal financial controls established. Not only established, but they have to also monitor its operating, whether it's operating efficiently and effectively. So the ownership of having internal financial controls is at the top, at the director's level. Now we'll look into the key objectives of internal financial controls. The key, first and foremost, objective is strengthening the financial controls. Any business which is doing any kind of business, like the product can be different, the area in which they are dealing, the kind of the gamut they are dealing, it can vary depending upon the company to company. So first and foremost, objective of IFC is to strengthen the financial controls, because any organization is run to have some kind of financial benefit output out of it. So IFC here is to evaluate the effectiveness of internal controls over the financial reporting. Second aspect of internal financial control is from the compliance point of view. Not only the financial controls or the financial strength of the company, but also it ensures the alignment with the Indian regulatory standards and laws. In a country, a company has to adhere to various kinds of laws. It can be the Income Tax Act, it can be the GST, can be the Companies Act. So through these internal controls, they try and establish that the company is aligned with the regulatory standards and laws. Risk management: identify and address risks in financial and operational processes. So, internal financial control also has a great role to play in identifying the risks which are there in day-to-day processes in the business, new business areas. So, it helps to address the risks and also to have some stop gap arrangements. Enhanced governance: support decision making and accountability by enhancing reliability of the financial statements. Here, if we see that if there are proper, robust internal controls in any organization, the kind of work happening there or the kind of financials being established there, the reports as being established there are enhanced and more reliable compared to other organizations, which helps the investors, the stakeholders in their decision making. So I would say these are the major key objectives. There can be various other objectives, but these are the few major ones. Now we'll try and understand the rules and responsibilities of each and everyone in this scenario. So first comes the board of directors, responsible for establishing and maintaining internal financial control. Here, as we saw, the section puts the ownership or puts the duty on the directors to have the establishment or the maintenance of the internal financial controls. So it has to percolate from the top to the management and to the managerial level. So first it starts at the director level. They have to take the initiative. They need to have the urge and they need to have the culture in their organization, establish such kind of controls so that the day-to-day running of a company is more efficient and is more transparent. Second comes the audit committee. Along with board of directors, I see audit committee has also been put the ownership by the act through the section 143 and section 177, through which they have to oversight the internal financial control adequacy and effectiveness. They are the ones who will actually help the board of directors to establish the internal financial controls. Third comes the management. Management are the people who are running the show day to day. They are the ones who are into the business, who are running the business, and who are dealing with the processes day in, day out. So management has to ensure the implementation and monitoring of internal financial controls. They are the ones who will be actually implementing the design in various departments, in various processes. They are going to identify the areas where it has to be implemented, and they are the ones who are going to monitor and check time and again whether the financial controls are adequate, efficient, or they need to be updated. The role of external auditor here is of he is a person who reviews and reports on IFC effectiveness in the audit report. As per Section 143, the external auditor has to mention in his report whether the internal financial controls of the organization are in place and are in effective manner. So the auditor's objective in an audit of internal financial controls or financial reporting is to express an opinion on the effectiveness of the company's internal financial controls. So the Companies Act empowers or gives the onus on the directors to have the established internal financial controls, and it also gives the duties to various of these factors like board of directors, audit committee, management, and the external audit. Further, we'll see the key benefits of internal financial controls. So now we saw that as per the Act, we have to have in place the internal financial controls. So now we'll see what are the key benefits of having internal financial controls. So enhanced financial accuracy and integrity. IFCs ensure that the financial data is accurate, reliable, and free from error. So any organization which have the internal financial controls in place, the first importance of having IFCs is to have accurate and reliable data, which is free from error or any kind of misstatements. So it ensures that the financial reports which are being established are true and fair. Consistency in accounting process with applicable standards and regulations. So day-to-day accounting processes or day-to-day processes are in accordance with the policies and regulations and are consistently being followed. Not only the financial accuracy and integrity, but also the operational efficiency. Well implemented controls streamline processes, reducing duplication and inefficiency. So if we have a well implemented financial controls or controls in any organization, this streamlines the day-to-day processes of any company or any organization. This helps the organization to behave or act in those roles in a very seamless manner. And there is no place for duplication or errors. So if anyone is having the effective IFC, it will be in a controlled and seamless manner. The process will be in a controlled and seamless manner. It also helps to identify area of wastage or unnecessary expenses. So internal controls also help to identify wherever there are gaps, wherever there are wastages, and wherever there is unnecessary kind of expense or cost of the company is at stake. The benefit of IFC that it also gives the stakeholders a kind of confidence. Robust controls provide assurance to stakeholders, including investors, auditors, and regulators, that the organization is well managed. So whenever any third person or any investor or any outsider is looking into the financials and is aware that the company has got the IFCs in place and are in effective manner, they get a confidence about the working culture of the organization, and they get a confidence that the organization is a well-managed organization. Enhanced trust leads to better market reputation and investment opportunities. Not only the current stakeholders, but also The reputation in the market grows and new investors are interested in the organization to invest. Business continuity. So, as we discussed about the risks identification, so one of the risks can be of the business continuity. So, having effective internal financial controls, it ensures financial stability and preparedness for unforeseen circumstances. So it helps to have a process which helps in identifying any kind of error, any kind of frauds, or any kind of unforeseen circumstances which can be taken care beforehand. It also contributes to the organization's long-term sustainability. A firm internal financial controls are, as we said, it increases the reputation, so it increases its stability also to be in the market. Now we will look into the applicability of internal financial controls. Per se, in the company's law do not have a kind of a restricted look in the internal financial controls. Internal financial controls are applicable to all the companies, be it a listed company or a unlisted company or a private company. It can be used or implemented by all the companies. But IFC is applicable to all the listed companies, being the stake at a major level, because those are listed companies. The stakeholders are of a variety. They need to have a certain comfort and assurance about the financials. So IFC is applicable to all the listed companies. IFC applies to unlisted public companies with a paid up capital of at least 25 crores at the end of the previous financial years. Here again, the stakes are high and hence the IFC is the requirement. There is no exemption per se, but wider notification, MCA has given certain exemptions to private companies or the small companies which are run by one person or which meet the following criteria, like the turnover of those companies is less than 50 crores, or they have aggregate borrowing from banks, financial institutions, or any body corporate which is less than 25 crores. These are the exemptions stated by the MCA. But as if we look into the day-to-day working of any organization, any company, so the applicability of internal financial controls is a must to have the kind of business you are expecting, to kind of profit or to a kind of income generation you're expecting. So having internal financial controls will definitely help to achieve your aim. Now, going ahead, we'll look into the component of IFC framework. Now, as in we decided, or it's as per the law that we need to have the internal financial controls. So we need to have a framework, or we need to have some kind of a structure wherein we start establishing the internal financial controls. So to have an internal financial control, I would say it needs a kind of an environment in that organization. As we saw, it comes from the directors, this ownership. It needs to have that kind of culture, that kind of a thought process, that kind of a vision to have the internal financial controls in place. It talks about the integrity, values, and the commitment of the overall organization. So it starts with the risk assessment. Whenever a company or any organization has to have or to build or to implement the internal financial controls, it has to first do the risk assessment. That is identification and analysis of risk. For that, they need to have an understanding of current processes and current way of working in the organization. There are various kind of processes, there are various kind of internal transactions happening. So all those needs to be visited and understood. And then there is a kind of a risk assessment. Where are the gaps? Where are the leakages? And what kind of controls are expected? And what kind of controls as per the standard norms are required? So those kind of risk assessment are done. And based on those risk assessment or based on those identifications, there are certain control activities. Control activities as in through the policies, procedures, are are maintained. Like we see the standard operating policies, procedures in any organization. So it arrives after the risk assessment. When you assess there are risks in certain transactions, in certain processes, then the control activities are established. A kind of control design is established so that the workflow is in such manner that it has to go through various kind of matrices, various kinds of checks, and those transactions are handled by many people, not a single person. So this way, there is a policy and procedure in place. Now, once the policies, procedures, or the design, control design is in forming, in structure or its form, it's documented. So that document needs to be in some central location where everyone can have access to that document. So information and communication is a very important pillar in IFC. So it ensures the accurate flow. It needs to be flown to each and every person who's related to that process, may it be the management, the manager, the process owner, or anyone who is part of that process. They should be aware of the policies and procedures or the way that process or that transaction needs to be done. So information is a very important thing to which helps to have the IFC implemented in a very smooth manner. Not only implementation, but monitoring of the controls. It's a kind of ongoing evaluation and improvement. We cannot say that, okay, we have established the IFCs and it's once and for all. No, it's an ongoing process, ongoing evaluation and improvement process. It needs to be monitored as and when required and need to be updated if required. If there are any changes in the processes, if there are any new business scenarios coming into place, then those old procedures, old policies needs to be revisited and updated. Now, as we saw, the IFC is implemented, IFC is being monitored, and it's in place. But a third review or a third person review is a must. As we saw, as per section 143, the auditor has to uh, state that the financial controls are in place and are effectively and efficiently in process. So for that, there is IFC audit. So it's like any other audit. It starts with planning and defining the scope. To start the audit, we need to develop a preliminary audit plan covering matters such as general scope and timing of engagement, audit plan based on the understanding of the company and its environment. I would say it is the basic work which we do in any kind of audit. But in case of IFC audit, I would say it is more deep dive planning and developing a audit plan because we have to have a check of each and every control process, each and every transaction happening in the organization. Once the plan is ready, once the area is understood, once you have understood the nature of business the company is into, we need to do a risk assessment. So risk assessment is obtain an understanding of the company, including its internal control by using techniques like walkthrough to understand gap, analytical procedures to identify material misstatements. So here there are various techniques which auditor has to apply during his audit. Understand the way a company is being run or the internal controls are being in place. For this, the main technique which usually is done is a walkthrough. So there is a standard procedure or there is a standard policy document, and there is an actual process which is actually happening in the day-to-day working of the business. So we need to have a clear understanding of the policy document and then a clear understanding by way of walkthrough about the transactions, about the processes, about the control metrics applied. Doing that, we get an understanding about the gaps. We get an understanding or we identify if there is any material misstatement, if there are any errors, if there are any gaps in the areas. After we do a thorough risk assessment through various techniques, then comes into picture the control testing. Once we have identified the risk areas or the areas which are of utmost importance, then comes into the part is the control testing. Risk assessment cannot be done at the face of anyone's financial report. It needs to be a top-down approach. Like you view the financial report, you go through the notes to accounts, you also refer the past audit reports, and then you understand the different business segments, business areas, transactions. Then you percolate down till the actual transaction level to get the risks. And once you identify the risk or once you identify the risk as, areas, you have a control testing. Develop an overall testing plan, like areas to be covered, number of staff involved, timing and extent of testing, perform testing of design and effectiveness of the controls in place. So this is the actual work which is to be done thoroughly by any auditor, where he uses various techniques, various tests on the defined area where he is working on. So he has to have a clear understanding about which or clear understanding to what extent he has to go and do the testing. He need to identify the staff which will be involved depending upon the nature of the business, nature of the transaction, the kind of expertise which is required to do the testing. So he has to have a clear understanding of that. Once the control testing are done and he's able to identify the gaps, or I would say the material misstatements, then comes the part of reporting. So the auditor should identify the misstatement and control deficiencies individually and in aggregate to form an opinion. It's not only about a specific transactions, but about the overall internal financial control implemented in the organization. So he has to have an observation or his report in that term. He cannot have only limited report about any particular transaction. He has to study the internal controls. He has to understand the gaps. He has to define the areas where have gaps and report in his reporting. Now, going through this, we'll further look into the challenges in the IFC audit. So there are certain challenges when we do this kind of a audit where we have to go through the each and every transaction, each and every policy document of the organization. So first challenge, I would say, would be complexity in the process. Looking at the kind of audit or looking at the way we have to check the controls, it is difficulty in identifying and documenting all controls. Being an external auditor, definitely there are going to be certain areas which are not informed to us, which are not known to us. So that kind of difficulty can be there if we have covered or if we have documented all the controls, all the internal financial controls. Further, though we have identified or though we have got to see the processes, the internal controls, identifying gaps in the controls, as different controls will be there in place for different kind of businesses, nature of businesses. So to identify the gaps in the control can be a challenge for any auditor. Changing regulatory landscapes. We are in a dynamic world where the rules, laws, and regulations are changing day in, day out. So we need to keep a track of the regulatory updates. Not only the regulatory updates, but also are there any changes in the business setup, business organization setup, which will give a difference in the internal financial controls? Will it need to be updated? Is it updated? So that kind of challenge can be there. Resource constraint. Now, this is a kind of a challenge which each and every person or each and every auditor faces in any kind of audit. The same applies to the IFC audit. So, lack of expertise and resources. Looking at the kind of business or looking at the kind of audit this is, the expertise of a different kind. The testing scenarios, the control testing scenarios will be different. So, the expertise and the expert will be different. Also, we'll have to depend on some technical expert in certain controls. As there will be different nature of businesses, the internal controls will also be differing from company to company. So there can be certain areas where our expertise will not help us to audit the controls, will need the help of some certain technical experts. So which can be a challenge again. Coordination between departments. As an auditor, we need to work with all the departments which are there in the organization to go through the internal financial controls, to understand the transactions, to understand the controls, to understand the policies which are there in place. So there can be a challenge while ensuring alignment and cooperation with the different people or different managerial people in the organization. There can also be difference of opinion among the management depending upon the different departments. So while gathering the evidences, while gathering the information, while doing the testing work, control testing work, while assessing the design of the internal financial control, we have to deal with the different departments in any organization. So while doing that, the coordination might have a challenge. Now we'll look into the a case study like internal financial control for a procurement process. There can be various IFCs for various processes. I'm taking this one of the example to just go through the different scenarios which come into picture of internal financial controls. So in case of procurement process, the first and foremost step in the procurement process, I would say, would be the vendor selection and approval. In case of vendor selection, there can be many challenges like the new vendor will have to maintain a vendor master list, which should be updated regularly. In any organization, there can be a variety of requirements. For that, there can be a variety of vendors which need to be maintained in a master list. I would say a active master list because day in day out vendors can change or they can stop their businesses. So the vendor master list need to be a active vendor master list. The due diligence. Conduct background checks and financial stability assessment for new vendors. Any new vendor, before onboarding any new vendor, there should be a thorough background check about not only from the financial aspect, but also from the quality per se of any kind of service or product which we are going to take from the new vendor. There should be a formal approval process for vendor onboarding. They need to have certain checks before those approvals, and those approvals should be there in place before any new vendor is onboarded. So there should be certain control matrix, authorization matrix in place for vendor selection and approval. Next comes the purchase requisition and purchase order. So once it is decided that this vendor, a particular vendor is onboarded and a particular kind of material is to be secured from him or her, the purchase request must be approved by the designated authorities. So there should be a authorization in the purchase requisitions. Once the purchase requisitions are approved and are in place, the purchase order is in place. Purchase order or a PO generation should only happen post the requisition approval. Once the requisition is approved, then only a PO is placed on the vendor. There can be or there should be automated systems to match POs with the approved purchase requisitions. These are the kind of internal controls which we are talking about to have a control over the new purchase order which is being placed or new order on any new vendor or any present vendor. There should be a certain processes which needs to be done before a formal PO is placed on a vendor. Once the order is placed, we receive the goods. So there comes the stage of goods receipt and verification. So here there are different documents need to be checked. There are different authorizations need to be there in place before the before the goods are in our premise or in the premise of the organization. So the following documents needs to be verified before the invoice is given for the payment. So first and foremost document would be the purchase order, which we have placed on the vendor, the goods receipt note or the GRN, then the vendor invoice. So all these three documents should be in line. There should not be any differences in these documents. Inspection of received good against the specification in the PO. There should also be a quality check. Once the material is in the premise, once the GRN is done, it needs to be first checked, or a quality check needs to be done on the goods, and then the approval or the green flag should be given for the goods. Once the quality check is done and the quality is been assured and the goods are according to the purchase order, according to the requirement of the company, then the invoice can be taken for the payment. So payment processed only after approval of invoices. Now, one was the goods receipt. That means in one step, you checked the goods, the actual goods were checked, whatever were received according to the purchase order, according to the requirement. The second step is the checking of the invoices. Is the invoice in line with the GRN? Is the invoice in line with the PO? So this is another step before the payment is done. There is a segregation of duty. Like there should always be 2 to 3 people who are handling this activity. So person who is authorizing the payment should not process it. The person who is approving the invoice is a different person, and the person who is actually taking out the payment of that vendor is a different person. So there is a people involved here. There should be a regular vendor reconciliation to detect and resolve discrepancies. As and when there are different kind of vendors which are registered with the organization, having various kind of transactions month on month. So it is the primary requirement to have a reconciliation established between your vendors so that there are no gaps. There should not be any scenarios like the invoice was not processed or the payment done was not accounted by the vendor. So these kind of gaps can be mitigated if we have a proper reconciliation process every month or every fortnight, which helps the organization to identify any gaps. So this is one of the example of a internal financial control for procurement process. In this manner, the company or the organizations should have certain procedures, certain authorizations in place so that each and every transaction goes through those particular processes. These processes will help the management or the people who are working daily, day to day in those processes to have a clear understanding of the way of working so that no process or there is no miss out of any kind of thing which can have a big impact in the later stage. And hence, there should be a internal financial controls in place. We have a very good guidance note by ICAI on internal financial controls. But I would say it is the internal controls over the financial reporting. So internal financial controls, as per the Companies Act, is a kind of a structure, robust structure, which the Companies Act is asking organizations to have in place. Whereas a auditor's role while doing those internal financial audits is is a very narrow scope depending or limited to the financial reporting. As we cannot have the controls, day-to-day controls which are there, we cannot have it in our gamut to have it in our reports. So the guidance note will guide you definitely to have a clear understanding about the role of our auditor and the areas which we need to have checked, verified, and reported. So in this way, I think I could help you understand whatever limited knowledge I have, whatever knowledge I gained through my experience. So internal financial controls, I would say, is the backbone of any organization to run it smoothly and in an effective manner. Thank you so much. And I hope you got some good insight on this topic and I could make justice to the topic. Thank you. If we have any questions or if any one is sharing any information, if you can share that, it will help all the team members or all the viewers.
Let me check with the questions. Some of the members are asking for the PPT presentation of this webinar.
Yeah, sure. I will share this PPT with the team, and maybe they will help you by through the mail or some other way.
Not much, no more questions. Members, please ask your questions. If anyone has any question, please ask.
I hope everyone could understand some important areas about the internal financial controls.
Exactly.
Okay, my email ID is there in the PPT. Not now or later also, you can definitely ask or share your views on the topic.
There is one question.
Yeah. Let me see if I can answer
How
it.
vendor selection process can be improved in an organization?
Okay. The internal financial controls, which I explained as a case study in my PPT, this can be the starting point to improve because it's an ongoing process. We cannot say that once a process is implemented, the procurement process is streamlined. It's an ongoing process because the requirement of organization will be changing in the dynamic scenario. It will be changing the requirements, the business might also change, the business requirement might change. So those needs to be structured or implemented according to the business which they are dealing into.
Okay, so I hope everyone has understood the topic very well. And anyone has any questions can ask the ma'am via email. She's there to answer all your queries. Fine. It is both an honor and privilege for me to extend the formal vote of thanks today. As we have come to the conclusion of this insightful seminar on the internal financial control. On behalf of the organizing committee, I would like to extend my heartfelt gratitude to all those who have made this webinar a resounding success. Firstly, I would like to express our sincere appreciation to our esteemed speaker for their invaluable contributions. Your expertise, knowledge, and thought-provoking presentation have greatly enhanced our understanding of the critical role that internal financial controls play in ensuring transparency, accountability, and efficiency within the organization. Your insight into best practice and emerging trend will undoubtedly guide us in implementing stronger financial management systems. Okay. To all the participants present here today, thank you for your active engagement and thoughtful questions. Your enthusiasm and commitment to learning are what truly make this webinar meaningful. We hope that you leave this seminar with a deeper understanding of internal financial control and a renewed commitment to applying these principles in your respective roles. Thank you everyone for your patience listening. Now, moving forward, I hand over today's session to our next moderator. Thank you, ma'am. Thank you for the session. And I request our next moderator to take the charge for next session. Thank you so much.
Sure, thank you so much. Hello, good afternoon, all. I'm CA Kshitija, and I would like to introduce you to our today's second speaker for the next session. So, Mrs. Sapna Kotari, she is a chartered accountant and she's actively involved in her firm practice. She is significantly contributing to her firm towards the client operations and marketing. With the past experiences in the corporate and the financial services in corporate companies, she is passionate about empowering the woman through the financial freedom initiatives. So I would request her to start her today's session about smart financial planning for women chartered accountant. And I'm equally excited to hear from you, ma'am. Welcome to the webinar.
Yeah, thanks a lot. Hello, everyone. Thanks a lot, Kshitija, for such a wonderful introduction. So to begin with, just let me present my screen first. I hope my screen is visible to everyone. Yeah. So today here we are to explore the need and importance of financial planning and independence, especially for women, and smart ways to achieve our goals. So to start with the current market outlook. Currently, Sensex is at 80,000, and recent market correction has reduced valuation excess. Markets are under pressure, but long-term outlook is still positive. Sensex is at 80,000 and is highly volatile due to various reasons: global slowdown, rising geopolitical tensions, the interest rate trajectory, US presidential elections, and so on. But although it is so volatile, it has been able to deliver a growth of 17% YOY in the last 12 months. And this is driven by the macroeconomic sectors, 12 major macroeconomic sectors leading the charge. Few of these sectors are IT, telecom, healthcare, infrastructure, FMCG, and oil and gas. Over 100 million investors are actively investing in the Indian markets. This is the domestic investors have taken over the baton from the FIIs and are providing much needed support to the Indian markets. The recent stimulus and market valuations had resulted in FIIs offloading Indian equities across sectors. Earnings were also under pressure in the second quarter, thereby weakening the overall investor sentiment. However, India's growth story still remains powerful, with the country's economy remaining resilient and robust. So if you see, India is emerging as the fastest growing economy as per the IMF estimates. The GDP is rising at 8.5% CAGR. It is almost the fastest growing economy amongst its peers. And this is backed by this is because of growing consumer base. So there is a vast population with rising disposable income, and just a minute. Yeah, so vast population with rising disposable income, and consumer preferences are tilting towards premium products in line with rising income levels. Secondly, government initiatives. So the structural reforms undertaken by the government, like Make in India, UPI, GST, National Logistics Policy, etc., has put the economy firmly on a growth path. Thirdly, infrastructure development. India's current growth is led by CAPEX. There is a huge impetus on CAPEX and infra by the government. And this is on the back of buoyancy in tax revenue and high GST collections. Improved balance sheets and of the corporates and banks has also led to the private CAPEX picking up. And lastly, digital transformation. Digital platforms are improving efficiency and transparency of government services. Technology is revolutionizing banking, payments, and financial services. Online shopping platforms are expanding rapidly. All in all, put together, India is set to become the third largest economy by 2028. So if you see, in 2010, India was at the ninth position. In 2022, we climbed up the ladder and we were at the fifth position. And by 2028, we are set to become the third largest economy. So this is the Amrit Kal era for India. With the Sangam of talent, capital, and infrastructure, India is in a bright spot in the world that is facing geopolitical tensions and other economic challenges. So if we look at the statistics, talent, from a talent retention point of view, 35 Indian origin CEOs, okay, have been managing the top companies across the world. So there was a statement made by CEO Shantanu Narayan, that Adobe CEO. If I was growing up right now, no way I would leave Hyderabad to go to USA. So that is a kind of talent that we have in India that we are talking about. Secondly, capital. With high forex reserves and increased tax revenues, government is equipped with capital. And infrastructure is the area where India still lags behind from the peers, which is now attracting a lot of government spending. So if you could see the expenditure growth, the capital expenditure has been on a growing trend. So government is emphasizing a lot on capex and infrastructure. So even during the COVID times, pandemic times, India was prudent. The world was not. So if you see, India was able to manage their GDP and public debt. So both of them moved in tandem. Whereas for most of the countries globally, the public debt increased multiple times as compared to their GDP numbers. And this is the reason why we are having at an all-time high forex reserves right now. And we are all set to have the fourth largest forex reserves by 2024 year end. So in the last 10 years, we have experienced huge growth, equivalent to what India has experienced in the last 67 years. That is why India is witnessing a 67:10 growth scenario. If you see in FY13, number of airports in India was 70, and in FY24, it is around 200. Similarly, the highways cumulative length in kilometers was 81,000 kilometers, and in 2024, it's 1,65,000 kilometers. So this is the kind of growth that we are looking at. Also, the state GDP numbers are now matching India's past GDP levels. State GDP of Maharashtra in 2023 is equal to India's GDP in 2005. Similarly, UP and Uttarakhand GDP in 2023 is equivalent to India's GDP in 2001. So this shows that India's journey is far from over and the future looks promising. So how are we placed to capitalize on this golden opportunity in the Indian economy and create wealth for ourselves? So let us now begin with our financial planning and wealth management topic. So there are three major aspects in financial planning and wealth management. First is wealth creation, second is wealth protection, and third is wealth transfer. So what is wealth creation? In an interview, Rakesh Jhunjhunwala was once asked, what is your worst investment till date? His answer was health. So basically, wealth creation is buying yourself the ability to have self-time and peace of mind. So if you have that, you have created sufficient wealth for yourself. Let us understand this with the help of an example. So Mr. and Mrs. Joshi, they started their investment journey with only 20,000 per month SIP. So they invested for 25 years. Their investment strategy was investing in equity Sensex fund, that is index funds. And their investment approach was set the target and forget. So they did not actively manage their portfolio and they just enjoyed their lives. So what kind of wealth do you think they would have created? In the first 5 years, 17.5 lakhs. In the next 10 years, 52.6 lakhs. In the next 15 years, 1.23 crores. After 20 years, 2.65 crores. After 25 years, 5.51 crores. So this is compounding at 15% per annum. And you can see the beauty and magic of compounding, that how merely a 20,000 invested on a monthly basis will help you create a large corpus in the long run. So this is basically how our markets have performed over the period of time. So whether it is during the COVID, during subprime crisis, during the Lehman Brothers bankruptcy, or during COVID, the markets have seen dips in short terms, but they have they have steadily increased over a period of time, and thereby delivering good returns and making large portfolios. So what is important is not to time the markets, but to stay invested for a long time in the markets. The time you're invested in the markets will reap you the benefits. So there are two stories that came across in 2010, which got a lot of publicity. One was of Richard Fiscon. So Richard Fiscon, he became famous for his tale about financial mismanagement. So this person was a Dartmouth College graduate, okay, and he got an MBA degree. He became a vice chairman at Merrill Lynch. He quit for his personal interest in 2000. In the year 2000, he was included in 40 under 40 list, but he filed for bankruptcy in 2010. In contrast, Grace Gardner, she lived a humble life. She died in 2010. All of her life, she worked as a secretary for 43 years in Abbott. No fancy living, no family, no car, no room apartment. She left behind $7 million for charity after her death. So this shows that financial success isn't about knowledge and resources, but it's about behavior and decision making. The longer you're invested in the market will always reap you benefits. And so with this background, how should we approach our finances? Goal-based planning keeps you motivated and focused on achieving specific targets, helps us manage our resources efficiently, whether it's planning for a new home, office, factory, new car, marriage, child education, child marriage, retirement, vacation, holiday planning, anything. We should have set clear goals. One of the most important goals in our lives should be retirement planning. Especially we women we as women should ensure that we are financially independent even after our retirement. So this is an illustration which shows that if at the age of 35 years, your monthly household expenses are 35,000 per month, with the inflation of 7%, your monthly household expenses at the age of 60 is going to be around 2 lakh rupees. So you require a retirement kitty of almost 6 crores. And this 35,000 is a very small amount that we have considered. Currently, if we see the average household monthly expenses is anywhere around 50,000 to 1 lakh. So you can you can use the same multiple for the retirement kitty required. So we need a 10 crore corpus for our retirement. Although this number looks very big, but disciplined investment for a longer period of time will make it easy to create this kind of a corpus. Second important goal is child education. So if you see the current statistics, almost 78% Indian parents are sending kids to study abroad. Everybody wants their children to get the best of the education out there. And 64% of the retirement savings of the parents is going into the child education. So all our hard-earned money, we are going to spend for our child education. In order to avoid this, we need to plan ahead. We need to start investing early for our children's education, to ensure that we are able to meet their future needs. All the expected tuition fees in India, all the expected education costs are rising in India. An MBA today costs 30 lakhs rupees, which will cost 61 lakh rupees by 2030. MBBS will cost almost around 1 CR. Engineering, almost around 40 lakhs. So with all these increasing costs, we need to secure our future. We need to plan for expenses like tuition, books, accommodation, living costs, etc. And we have to create a sizable corpus for our children's education. While we are doing the goal-based planning, there are a lot of hurdles that may come in our way. First is inflation. Inflation may erode our purchasing power and make it harder to achieve our goals. So we should bake in the inflation in our financial planning goal. Second is lifestyle upgradation. Meeting increasing lifestyle expectations can strain your finances, impacting your goal accumulation. Third is unforeseen circumstances. Unexpected events like medical emergencies, job losses, etc., can derail our plans and financial adjustments. Fourth is, of course, market volatility. Fluctuations in stock market can cause uncertainty and impact your investments. So how do we overcome these hurdles? Is by proper investment planning. Investment planning involves setting financial goals, identifying assets, determining your risk tolerance, diversifying your investments to maximize returns while managing risk. So we should have a diverse portfolio. We can invest in gold, real estate, fixed income, equity, and mutual funds. While these three asset classes, gold, real estate, and fixed income, may give you stable returns and average, but these will be average returns. Equity and mutual funds is one asset class which is going to help you create a large portfolio in the long period. So this is where this is the product which will help us to create a large portfolio. So deep diving into equity and mutual funds. Investing in equity. So while investing in equity, research is something that is essential. Without enough research, we cannot select any stocks. We need to check the company fundamentals, the price, the PE ratio, etc., the earnings of the company, etc., while selecting a stock. High risk and high reward. Investing into equity is high risk, but the reward potential is also very high. Third is time and knowledge. You need to have sufficient time to keep reviewing your portfolio and knowledge to understand how the stock is performing, how the company is performing. And you need to keep this under your radar always. So these have high growth potential. They also have a scope of income generation through dividends, and they give you an option of portfolio diversification. But what we should stay away from is quick money. That is, quick money from F&Os, speculation, trading, as it is not possible to time the markets. We should keep adding good blue chip stocks whenever we have funds and target to create a strong long-term portfolio. The second option that we have, which is a safer bet than equity, is mutual funds. This industry is booming today. So the assets under management in the mutual fund industry is 67 lakh crores and almost an SIP book of 25,000 crores. This signifies consistent investor confidence. So investing in mutual funds by selecting good funds based on your investment objective and your investment horizon, or with the help of an advisor, and investing in a disciplined manner, this will ensure that you create a large corpus in the long run. So there are various types of mutual funds. Equity mutual funds, which are majorly invested into direct equity, and debt mutual funds, which are invested into corporate bonds, G-Secs, and other debt products. And hybrid is a combination of equity and debt. And there are also liquid funds. We will deep dive into all of these. So first is the equity mutual funds. So equity mutual funds are again bifurcated on the basis of, there are again different types of equity mutual funds based on market cap, say large cap, mid cap, small cap. There are multi-asset funds. There is something called as multi-asset funds, which invest across the different asset groups, like gold, government securities, debt, etc. There's something called as diversified equity funds, which they invest across wide range of sectors. There are sectoral funds that focus on specific sectors, and then there are hybrid funds, which again invest into mix of asset classes. There are various ways of investing into mutual funds. First is the systematic investment plan. You invest a fixed amount at regular intervals. This gives you the rupee cost averaging benefit, encourages consistent investing without needing to time the markets, and it will help you to create a good portfolio in the long run. Second is the lump sum investment route. So this is suitable if you have a large amount of money ready to be invested and believe that the market conditions are favorable right now, but this will have an immediate exposure to market fluctuation. The better way to invest a lump sum amount is through an STP route, that is gradual transfer from a debt fund to an equity fund. This will again give you the rupee cost averaging and reduce the overall risk. The third type of investment is a systematic withdrawal plan. This method is withdrawing the money from your mutual funds investments at regular intervals. Only partial amount of your investment is redeemed each time, allowing the remaining amount to continue growing. Thus, it gives steady income with capital appreciation in the long run. After the equity mutual funds, now there are debt mutual funds. Again, there are different types of debt mutual funds: liquid plus funds, floating rate funds, gilt funds, hybrid funds, accrual funds like corporate bonds and credit opportunities funds. Basically, these debt funds are favorable for risk aversion, diversification in your portfolio. They are preferable for short to medium term goals, and also when the interest rates are expected to fall as the value of existing bonds in your funds can increase. There is also something called as liquid funds. Now, basically, this is something that gives you short-term stability. Liquid funds are funds which are invested in high-quality debt instruments, making them low risk option compared to other mutual funds. They offer 7 to 8% annualized returns, and they are not linked to equity markets invested in debt securities. For example, an amount of rupees 10 lakh invested in liquid fund earns you 2,200 rupees in a year, 200 rupees in a day, and 80,000 rupees in a year, say at 8%. So now, as we are creating our portfolio, what is important is the protection of this wealth, the protection of the wealth that we have created from the unforeseen risks. And what could be these 4 unforeseen risks? First is any health issues. Sudden health issues can drain your finances, disrupt your plans. Accidental losses can lead to medical expenses and lost income. Natural calamities, disasters like floods, earthquakes, etc., they can disrupt your financial plan. And lastly, financial threats, claims, third-party claims on properties and professional risks can also eat away all your well-saved money. So how to safeguard this? Now is where the insurance comes into picture. First is the health insurance. Health insurance is the most crucial insurance that you should have in your portfolio. It is a must to safeguard your hard-earned money being used to pay hospital bills. So financial protection, a health insurance covers medical expenses, reducing financial burden of hospital bills, treatments, etc. It also provides us access to quality care. Whenever there is an unforeseen event, we can take the best of the treatments and we need not shy away from spending our hard-earned money. There are also options of family floater policies these days, which provides a comprehensive protection for all members. And with inflation cost, the YOY inflation is 13.8% in India, which is huge. So the medical cost inflation, if we do not have a good health insurance in place, it is going to eat away all our hard-earned money. So a health insurance is a must. A good PA policy is also recommended to provide financial protection in case of accidental death, disability, or injury. So it tells us that a new vehicle can wait, but health insurance cannot. We have to remember this. And if we do not have a health insurance, the first important thing in your financial planning portfolio should be buying a health insurance. Secondly, a good life insurance product. So life insurance provides a financial safety for dependents in case of untimely demise. According to recent statistics, only 15% of Indian population has life insurance, which is adequate to safeguard the interest of their family members. There are a lot of insurance products available in the market. A good term insurance is for every earning family member of the family. You may also have a look at the investment products available in the market today with return of premium options, which will create strong portfolio along with the risk cover. So there is a lot of products available in this segment. And lastly, the secondary assets also should be insured to ensure holistic insurance coverage, that is household, motor, and travel. All this should be ensured to have a financial safety net. So once we've protected our wealth, the last and most important thing in wealth management is wealth transfer and transmission. So this is one area which is often neglected by all of us. Why this is important is to ensure a smooth transition. Estate planning. We should plan the distribution of our estate after our demise. So we should have this planning in place to ensure that there is a smooth transition of our estates. Trusts and will. We should establish legal documents to ensure that our wishes are honored. We should ensure proper nomination in all investments and insurance products to ensure smooth transition in a quick period of time. And lastly, succession planning. We should plan to transfer our business ownerships, our management, our practices, etc., in a well-planned manner. Ways in which wealth transfer can be done is by writing a will or by creating a private trust. So what is the benefit of writing a will? It is you who will decide who will benefit from your hard-earned assets. Your distribution of assets is respected by the courts. The faster legal processes when applying a probate. You can decide, you avoid the need for two sureties when there is a will. So all these are things that we should be careful and we should plan well in advance. So with this, we can conclude today's session with the message that we should invest today and secure our future for tomorrow. And this can be done by developing a comprehensive financial plan that aligns with our goals, spreading your investment across different asset classes and funds to mitigate your risk. And thirdly is periodically keep reviewing your investment and make necessary adjustments. So with this, I would like to conclude my presentation, and all the best for all the investors who are going to start their journey. And I believe it's the right time. It's never too late to start your investing journey. So all the best and thank you.
Hello.
Yeah.
Thank you, Swapna ma'am, for taking such a insightful session. I have received comments from quite a lot of attendees that it was really helpful. But I would like to address few questions from the
Sure.
attendees and audience.
Yeah.
One would be many people are requesting for this presentation.
Yeah.
So can it be shared?
Yes. I'll share it with you so you can forward it to anybody who wants to have a look at it.
Yeah, sure. One more question is, one attendee is asking that there are many mutual fund companies in the market.
Right.
So how should one select the mutual fund company or the AMC, which will suit? Like which it is very difficult to compare between different funds. So how should we invest and how should a portfolio, if it is if a person, I can get from a question that he's asking that how should we plan our portfolio and how should we invest in the companies?
Understood your point. Yeah. So as you said, there are a lot of mutual funds, there are a lot of AMCs, fund houses, it is a lot of information available in the market, I would say. So along with that information, if you have good, you can take good insights from these magazines like Invest Wealth or Money Control. You can take a pro subscription maybe. So you can review how the fund has performed in the last, say, 6 months, 6 to 1 year. So if the fund has performed really well, and who is the fund manager? So there are a few fund managers from which we can understand that this fund is going to perform well. And you have to keep reading and you have to keep yourself updated on that. So once you have selected those good funds, it is just the selection procedure which I feel will require you to invest your time. Once you have started regular investing through SIP route, I don't think you need to keep reviewing your portfolio again and again. So you just invest once and you you can forget your investment. People who forget their investments are the ones who create very large portfolios. Okay, if you keep reviewing, if you keep tweaking it, changing it time and again and again, then you're not going to reap anything. And if you find that this is all too much, then you can take help of a financial advisor or colleagues like us, whoever you feel you are comfortable with, for the initial advice that will be required, for the initial knowledge sharing, basically, like how to design your portfolio between large cap, small cap, and mid cap, and maybe some sectoral calls that you can take. So this is how I think you should start with your investment journey.
Okay. If audience have one question is that what is your opinion on gold investment?
So gold is a very good investment right now. So considering that it is already on a all-time high, but by 2025, many experts have advised that gold will make a rally and it will cross the 1 lakh mark. So gold, it's simple that all eggs should not be in one basket. So you should have a good diversified portfolio. And I would suggest that you first create a strong portfolio in equity, in mutual funds, and then keep small amounts, keep accumulating gold over a period of time. Like if you have some surplus funds available, keep accumulating gold. So which will add on to your portfolio. I mean, if it is a physical form of the gold or the SGBs, currently there are no SGB series which are coming in yet. But yeah, we can wait for it. Or physical gold is also a good option. You can keep accumulating it over small amounts, and I mean, which will create a wealth in the long run. Yeah.
Great. I think there's one more question. Just a second. For long-term goals, which
Yeah.
mutual fund schemes are better?
For long-term goals, you can, I think, you can concentrate on small cap and mid cap funds. So small cap funds are basically those funds which are invested in small cap, companies with small market capitalization, which have high growth potential but have high risk. So if you have a good investment, good time horizon, say 5 years plus horizon, then you can look at small cap, and also not entirely small cap. You have to diversify it with mid caps and few sectoral funds. Like sectoral funds these days, the sectors that will do really good in the next few years is, like I've already mentioned, infrastructure, capex, IT, FMCG, all these sectors. So if there are some sectoral funds that you can add in to your portfolio, then I think this bucket will help you create a good portfolio. If you have a shorter horizon, then you go for large cap stocks. Large cap mutual funds. And also you can look at multi-asset funds, because they diversify their risks not only into equity, but debt, government securities, gold, etc. So multi-asset and large cap should be something that you should look for a shorter duration, and for a longer duration, it could be small cap, mid cap, and sectoral funds.
Okay. I think there are many questions coming up. One is, what will be your suggestion to a retail investor who has invested via SIP for 10 years to convert the profit and continue the SIP, or he should continue the SIP without converting? So
yeah, I understand the question. So here the tax angle actually comes in. So like we said, if it is a 10,000 SIP, it's been started for last few years, so it is probably a long-term investment, right? So I think you should, if the fund you have earned good returns and you think, but currently the markets are, I would not suggest you profit booking in the current market scenario, because we have had a recent correction, which will again, I think in the next few months, the market should again rally. In the next 6 months or so, the market should again come to 85,000 levels. So after that, I think you can book profits in those funds up to 1,25,000 rupees profit booking. So you can up to 1,25,000. It is long-term capital gains is tax. Yeah, it's tax free. So up to that extent, you can book profits and invest in other funds, so that you will get the benefit of tax harvesting. And on that capital gains also, you'll have to pay only 12.5% tax on any additional capital gains that you book. So that way you can plan your profit booking. I think.
Great. One more question. Since there are new tax regimes introduced, which new investment avenues one should be looking out for apart from the one which you have already mentioned? The,
So tax is something I think none of us can avoid right now. So in the new tax regime, simplification of the capital gains and everything that they have already mentioned in the recent budget. So going forward, I think old regime will be completely scrapped, and it is going to be the new regime way forward. So in the new regime, there is nothing great tax saving that you can do from a tax saving point of view. Okay. So tax harvesting is one thing that is up to 1.25 lakhs. You book your profits every year and keep investing that money so that you will get the benefit of tax harvesting. Other than that, whatever is the tax, I think we have to pay it because there is no other way where we can, save the tax from a capital gain point of view.
okay. Great. There is one attendee who is NRI. So, question is, being an NRI, I would like to invest in the correct medium when I visit India. So, can I email you or call you for the advice when I'm in India?
Yes, sure. So
How do they reach you?
NRI investment is not allowed in all mutual funds, but yes, there are a good amount of mutual funds available and options available for NRI investors, depending upon the location where there's of their residence. So you can always connect with me. Yeah. So my number and contact is there in the PPT that I'll share. So yeah, you can connect.
Okay, great. So, one question is, if someone wants to invest in gold, then suggest whether in soft gold, ETF, gold mutual funds, SGB, or actual gold.
So everything is one and the same, to be frank. Okay. So because there is no much price variations from a gold, because the underlying asset is same, right? Gold, the underlying asset is same. So if the SGB gives you a good tax efficiency point of view, but there are no SGBs coming in right now. So gold ETFs and gold mutual funds also give you good returns over the long period of time. And also the multi-asset funds, which have an exposure to gold. So all these three go in tandem. So any of the investment modes will give you same benefit. The physical gold, however, I would say will have some added advantage because of the purity and stuff like that. And physical gold is something, this is a physical asset. It is not linked to the market. So that way, physical gold may be better option as compared to these three investment options. But within these three investment options, I think all of them are at par. And it is a good option if you do not want the headache of having the physical gold and the logistics part and all that thing. Then it is better to go safer approach. The safer approach would be through gold ETFs or mutual funds, gold mutual funds. Yeah.
One more question is, what is the correct ratio between the large cap, mid cap, and the small cap?
So that ratio will completely depend on your investment objective and your risk appetite. So for a person who is of my age, say 35, below 35, has a good risk appetite, do not have much, any big financial burdens. I think if the portfolio is the portfolio has more of small cap and mid cap, it would still be okay. But for an investor with with minimum risk appetite, and I mean, depending on the age and other financial factors, the large cap side usually, I mean, it has to be person specific. I mean, we cannot have a generalized ratio for that.
Okay.
Depends on
So,
and also on the horizon, your investment horizon. So
yeah, basically your investment objective, right?
investment objective,
Horizon,
time in the market. Yeah. So if
time.
you're looking for shorter duration and achieving for shorter goals, then debt mutual funds or the hybrid mutual funds or the multi-asset funds will be good for you.
Okay. Great. So one question is, what is your opinion on small cases and which is better, small cases or mutual funds?
So again, this is a very subjective question. So I think it will be better if I see you have my number, I have shared my number and email. So if we can connect on one-to-one, then I'll always be ready to help any of you. Yeah.
Okay, great. I think that was the last question. So one is just yeah, PPT will be shared. So same people require that PPT. Many requests I've received for PPT. So great. Thank you so much, Swapna ma'am, for giving us such an insightful session. The way you started that how India is the growing market and how we should all take advantage of it was amazing, and how we should advantage, and how the way you covered all the aspects of that is wealth creation, wealth protection, and wealth transmission. It was really great to listen you from start to end, and looking at the questions, even our audience enjoyed it a lot. Thank you so much for taking out time and enlightening us. I would really also thank to all the attendees and all the audience for taking out time and attending the session. Thank you so much, everyone, and thank you so much for giving us a great session, ma'am. Thank you so much.
Yeah. Thank you, everyone. So I would like to inform all the speaker coordinator participants, like CA last date for nominating for CA Women Excellence Award has been extended to 11 December. So we request you to please nominate yourself or other member whom you deem fit for grant of the awards. Awards will be given in 5 categories. So we'll share the announcement of CA Women Excellence Award and link as well of the nominating on all the email IDs of the who are the attendee of the today's program. So please circulate or do nomination. Thank you so much for all the speaker, coordinator, and attendee for today's program. Thank you.
Thank you.
Thank you.
Thank you.